Hey investor friends, I'm Michelle Markey, and today I'll explain why expense ratios are destroying your returns in a mutual fund or index fund or ETFs, which are also known as exchange traded funds, and what you can do about it so you can save more of your money than giving it up to excessive fund fees. First, let's define what expense ratios are. These are fees that usually come with investing in diversified mutual funds or ETFs that contain a variety of assets, not just stocks. And these fees are the total operational and management fees that cover the expenses of the fund manager in offering the fund. And these fees are usually calculated on an annual basis and reflecting the assets under management and is usually disclosed on the fund's prospectus and shareholder reports. Do you like saving money? If yes, go ahead and smash that like button and please subscribe because it greatly helps out my channel and you'll come away from this video with a good understanding of why the lower the expense ratio fees, the better. Let's look at a little bit of history to give context behind the evolution of fees. And for retail investors like you and I, fees and commissions in buying stocks or funds used to be way more expensive in the past. And things like mutual funds have been around since the 1920s and gained in a lot of popularity in the 80s and 90s when our parents were first starting to invest. And then Jack Bogle invented the index funds in the 1970s. And with the rise of being able to invest in passively tracked index funds, that grew especially in the last couple of decades and has allowed the retail investor to save tremendously on fees, where we can often invest in funds below an expense ratio fee of 1%, whereas in the heyday of the mutual funds, they would be charging anywhere from 2 to 3% or more on their expense ratios. So that was definitely not great. And no wonder mutual funds were often mediocre, and why just simply tracking the overall market performance was a much easier and more profitable way to go for a lot of people when they buy into more passively tracked index funds or ETFs as opposed to actively managed mutual funds. And often in the past, mutual funds used to come with what's called load fees, or the initial purchase fee for buying into the fund. And nowadays there are a lot of funds that are considered no load or no transaction fee or NTF that have very little expense ratio. So that's pretty awesome for us retail investors. Another boon for retail investors is that there's been a lot of price transparency made publicly available on the internet over the last couple of decades. And that's also led to brokerage firms reducing their commission rates over time, and the competition for investors accelerated so much that in the fall of 2019, most popular brokerage firms slashed their commission fees to $0. And that was pretty awesome because that meant a lot more people could invest without the fear of buying small amounts of stock or funds and then having to pay a lot in fees. And I'm pretty sure that's why we've also had a huge influx of money into the stock markets, and it's made it way easier to overcome the barrier to entry. And if you're wondering, how is it that some of these brokerage firms are able to afford offering a lot of funds for little to no transaction fees? And they can do this because they offer other services like charging fees on option contracts, or if you hold funds for less than 60 days, then you're slapped with a $50 fee if you sell off the fund sooner than 60 days. And otherwise, they make fees by offering more professional investing advice, or if you close a certain kind of retirement account with them and then you roll it over to another brokerage firm, they charge you some fees for that. And other companies that are a little bit less straightforward with their fees happen when they do things like payment for order flow. And some of those other brokerage firms make money by charging you a little bit more on the bid or ask in buying or selling of a stock. So that's just something to pay attention to. If you think that you're paying no commissions, there's always some way that a fund makes its money, and whether it's in the format of an expense ratio or payment for order flow, the brokerage firms are making money nonetheless. For example, let's say you invested $10,000 over the course of a year in a mutual fund with expense ratio fees of 0.5%. The fees would have cost you $50 for that year. compared with if you invest in another fund that only charged 0.05% in expense ratio fees, that would have only been $5 that you paid in fees that year. And the savings of $45 is like having nine $5 foot long Subway sandwiches. So I consider that difference to be incredible, and how much you can save just by paying attention to the number of zeros in your expense ratio fees and doing the math so that you end up with investing in lower cost funds that give comparable yields. To really drive home the impact of expense ratio fees on your investments over time, let me show you some car analogies equivalent to the total cost of fees over time. And let's head on over to NerdWallet's mutual fund calculator, where you start out with an initial investment or principal of $6,000, and you contribute every year $6,000 to that principal, and you invest for 30 years at the stock market's average rate of return of 7%. And with a fund expense ratio of 2%, you see that the total cost of fees is $208,000, or equivalent to getting a Bentley, versus 1% would be a cost of fees of $115,000 or a Range Rover, 0.5% is $61,000 or a Tesla, and 0.15% is $19,000 or a Honda Fit, and 0.03% is $3,900 or a used 2006 Honda Civic, for a difference of $204,000. And I don't know about you, but I'd rather be racking in my Beamers, Benz, and Bentleys than giving it up in fees. Now that you know about the magnitude of fees, let's look at some practical examples. And just as a forewarning, I'm not endorsing any particular brokerage firm or funds. And even though I've used Fidelity as one of my brokerage firms, I'm not invested in any of these funds. So please take this as just for education and informational purposes only. So if we look at the Fidelity 500 Index Fund with ticker symbol FXAIX, we can see that they have an expense ratio of 0.015%, and they have a zero minimum dollars to invest, which is pretty awesome. And if we compare that to the Vanguard version of the VFIAX as their ticker symbol, they have an expense ratio of 0.04%, and they require minimum investment of $3,000. So just comparing the two real quick, for every $10,000 you invest in either one of these funds, you'll pay $4 with the Vanguard fund versus $1.50 with the Fidelity fund. And the other thing to note is if you look at that same Vanguard fund in Fidelity, you can see that it actually shows in red a little fee area, and it has a transaction fee or load of $75. So just keep that in mind, because you could be getting a comparable fund with the Fidelity 500 Index Fund because you're buying it at Fidelity, and they have a no transaction fee on their version of S&P 500 type of fund. So that's just something to keep in mind. And if you're also very curious about what's the best way to find low-cost index funds, I would just Google them, and you can see from this example Fidelity chart, they compare their common index funds to Vanguard's index funds that are very similar, and how much the fees differ between both of those funds. And please feel free to Google some more and learn as much as you can before you make any purchase of funds and decide how much fees you're willing to live with. In addition to Googling, you could also look up articles on lowest cost index funds or other funds that have low expense ratios in places like Investopedia, and other YouTubers cover some of their favorite index funds. So definitely check them out to learn more. The reason why I mentioned that I'm not invested in some of these funds is because they're super diversified, like having invested in hundreds of stocks that, quite frankly, I haven't done the research or homework with to really understand all of those stocks. So if I were to invest in any mutual funds, I might just pick one that invests in maybe 10 to 15 assets, and that's pretty much it, so that I can look through it and decide if I think this fund has a competitive advantage that I can't get anywhere else. So that's just something to be careful about, and I avoid winging it and just throwing darts at random funds that might have attractive sounding allocations of small cap, mid cap, large cap, emerging market, or international, because I don't really know what those are all fully invested in. So I'd rather play it safer. And ideally, I'd rather invest in individual companies' stocks like Warren Buffett and Charlie Munger do, because that way I can really get into the research and weeds of how a company is performed, if their management has integrity, and what I calculate as the real valuation of stocks, as opposed to a lot of funds that I don't really know where they're going. So it's just a big guessing game to me. But I know that they're really popular right now. So tread carefully if you're going to buy some funds. And if you enjoyed this video or learned something, please like and subscribe. And I'd love to hear from you in the comments if you have any questions. Let me know if how I explained the expense ratios made sense to you, or if there's another way that it can be said better. Happy investing. Till next time.